So today we have just me. Sorry about that. Mark is on a little bit of a business trip, and he is visiting Miami on a Bitcoin conference. So we will have some info on that when he gets back. What we're going to do today is we're going to go over something called Skew. So these next few versions of our Thursday market shot on Options Brew. We're going to be taking various topics and discussing them. Try to get it to the 10-minute mark. That's all we want to do, 10 to 12 minutes, we hope. A little more educational. It's certain topics that are familiar to us from the prop side of the business that we feel maybe not as prevalent in the retail side. Some applications are probably a little bit esoteric. We understand that. But others are useful to kind of get a grander scope of what you're looking at when you're looking at an entire options board. So today, what I'm going to talk about for maybe 10 minutes, I hope, is Skew. Okay, and I'm going to use TradeHawk to show it the Skew. So what is Skew? What's the history of it? Back in 1987, okay, believe it or not, I was on the trading floor back then. We had a crash. Okay, it was the biggest, one of the bigger, largest crashes we've ever seen, right? So it was a big, huge down day. And back then, the index options, the puts, the out of the money puts and the out of the money calls were priced similarly, meaning their implied volatility was almost the same, and to some degree, the puts were lower implied volatility than the out of the money calls. Why was that? Well, we hadn't seen a crash in the listed options world until that time. So what happened, what people discovered is that the velocity of movement to the downside is really, really significant compared to the velocity of the movement to the upside, especially in macro markets like an SPX or a Dow Jones. Okay. Now, we've certainly seen volatile, huge velocity moves to the upside recently in stocks like GME and BlackBerry, those sort of stocks. We've certainly seen that. And what you'll discover is that the skew actually inverted itself in those stocks. So it tends to go with velocity and demand as well. So when we talk about skew, let me share my screen here. So what are we looking at? This is a skew of Twitter. Okay. When I say skew, what you typically refer to is one of the months in question. Now you can look at multiple months, but I'm not going to confuse it in this session with that. Okay. So what we're looking at here is the blue line. Okay. This blue curve right here. That blue curve is what we call implied volatility. So it represents the skew in the marketplace for Twitter. Okay. And for July 16th, 2021 expiration. Okay. That's number one. The curve, the red curve down below, and I'm going to draw red on red here. I hope you can see it. So that curve I just tried to outline. That's the curve that we call a user-defined curve. That's something that I created based on a set of parameters. Now, we're not going to go over the parameters in this video, but just know with these parameters that they are normalized. What normalized means is that we take a mathematical function, and based on the time to expiration and implied volatility, we take these coefficients, what we call coefficients, okay? And we put them into the model so that any given month can use the same coefficients to derive value from a skew curve. Okay, I know that's heady and a mouthful, but think of it this way. If you're in July, okay, these values will define your curve. Okay, you can see my red curve is kind of similar to the blue curve. I'll explain what the differences are in a sec. And then you can take those same values, these same coefficients, and plug them into another month, and you will get a identical curve, but it'll be mathematically computed on our back end based on the time to expiration and some of the other features that create that curve. Okay. All right. So I want to stay away from a lot of math here. I want to make this simple. So what we look at with a curve, okay, and again, this is July, is we look at the money. That's number one, okay? That's that spot I just drew. So the at the money volatility, as you can see, is roughly 39.6, Okay, that's what that volatility is that I just circled. And you can see the volatilities going this way, lower strikes. That's this path here. Okay, so 60 on down. And you can see the volatility going up in strikes from the at the money. And that's this path here. Okay. So where skew comes into play, and you will see skew in just about any underlying stock, okay, and index for that matter. The other thing that happens with skew is that the investing public, you and me who do this, we tend to hedge portfolios. How do we hedge portfolios? We buy downside puts and we sometimes sell upside calls. What does that do? That puts pressure on the downside puts. If everyone's always buying them, someone has to sell them to you. Those people skew those values higher and higher, and you start getting this curve that you're seeing here. Okay, so people who have to take the inventory, market makers, they keep selling this thing, so they just keep raising their prices higher, and this curve gets steeper and steeper if the demand for those options becomes great. And then when they're selling the upside up here, the market maker has to buy those things, and he keeps lowering those values. So that's a very typical behavior in the retail world and the investing world, to be buying downside protection for your portfolio and selling some upside calls to offset the purchase of that put. It's called a collar. Okay, so you tend to see skew that way as well. In addition to that huge velocity of downside moves that started in actually back in 1987. So in terms of the equation, it's a mathematical equation, first of all. Okay, so keep that in mind. This is performed mathematics. What TradeHawk does is it computes a value. We don't show this in the retail world. It computes a value called tilt. Okay. Now, what tilt is part of the mathematics of this equation. It will tell you where you own skew, and tilt can be in a negative value, okay, or it can be in a positive value, okay. And tilt, which is skew, means where your inventory lies. So if you're selling a lot of downside puts and you're buying a lot of upside calls, okay, your tilt is going to be a bad number. I mean, bad number in that it's going to, if the market goes up and it drifts up, those long calls are going to tend to get hit and get heavy, and they're not going to move as expected. Conversely, those short puts that you have that are supposedly helping you to the upside, in my example, they're not going to go down as much. They're going to hold their value. Okay, so that's what tilt means. So it is an equation. Okay, for sure, mathematical equation. Conceptually, it's more important to understand it conceptually. Okay, buying and or selling a lot of downside puts has an effect. Buying and selling a lot of upside calls has an effect. Okay, if you're short upside and long downside puts and the stock drifts up, those short calls aren't going to move and behave as much as you would think they would based on the model. They'll get heavy. So that's a nice, we always said in the trading world, if we could be long stock, long some puts, short some calls, that was a position we love to be in. Those little drifts up in the marketplace, we would make money. And then we'd be buying in our short calls, selling out those puts that didn't move, and selling out the stock in between and getting out of that position. Okay, so that was a very favorable position for us. The other thing that skew does, okay, very important. It can also show where you might want to have inventory. So if you have a super steep skew to the downside, unlike what we see here. So this blue is the implied again, right? So this is what we expect in the marketplace. And I haven't done enough study of Twitter to know if this is a steep skew or not. I'm looking at a steepness of about 1.5. That number can be 10, it can be 20, it can be -5. But all that measures is that how steep is this part of the curve, okay? And 0 is like this, okay, flat. And the higher the number gets, the more steep it goes. So watch my red line, what happens. I'm sorry, let me erase this. Watch this red line, what happens when I start raising slope, okay? And I'm just going to raise it a point so you get the idea. See what's happening to it? It's moved beyond the implied now. It's just getting steeper and steeper the bigger I make that slope. So what's happening there is those downside puts, I'm making them more and more expensive relative to the upside calls. That's what happens when we make slope steep. And if you see steepness, okay, in terms of a trading vehicle, if you see that steepness, what you don't want to be doing is you don't want to be buying these steep overpriced puts. Okay, you do not want to do it. You want to figure out a way to sell those steep overpriced puts and then purchase the very cheap upside calls. So that's how Skew can help you. When it gets really, really, crooked in terms of steepness, you want to stay away from purchasing this stuff. Okay, and you want to look for spreads and trading ideas that can take advantage of that high volatility. Okay. The other way to think about Skew too is it's a relationship, right? Super simple relationship. What is it? It's a relationship of the put to the call. Okay. Now you can see in this example, and we typically talk about the 25 delta call and put. So that's right here. And I'm looking on the upside. It's going to be right about here. Okay. So you can see in this example, 48.8 on the 25 delta put, right? And 46.6 on the 25 delta call. Those are two different volatilities. You'd think they'd be the same, but they're not. Okay. So that put is a little bit higher, 2.2-ish volatility points higher. So 25 delta is always an interesting point. That's an inflection point in Skew. That's about the part where you start getting really cheap options dollar-wise, and you start seeing what we call a smirk. Okay, so right around 25 delta, you can start seeing this line start pinching itself up. And when we say smirk, it starts smiling, like, you get a flat line, no smile, and you get a little bitty grin, right? And the grin part is about the 25 delta put and call is where that starts smirking and pinching itself up. Okay. Now, a lot of folks can't play in this area. These 25, they're too small. The options are small. The important takeaway here is this should tell you if this number gets to be 60 and this gets to be 46, and again, I'm making those two numbers up, that's a big difference. Okay, that's high volatility downside, low volatility upside. Someone is buying these things, or someone thinks this thing's going to start moving down in a hurry. Okay. Now I clearly understand most of us deal in the at the money world right here. And you can see the at the money world, very, very little skew in there. The pieces are very close together. Okay. So the Skew will just let you know expensiveness, cheapness, and to what degree. Again, if this Skew, for instance, if it starts going closer to zero, and watch how I do this, I'm going to move this slope the other way. So there's 50 cents, almost zero. Let's go negative. So now all of a sudden negative, look what happens to my red curve. Now these downside puts are very cheap relative to upside calls. A phenomenon you hardly ever see in listed options, almost never. It can happen. GME, it happened because there's so much impetus to the upside and so much supply demand issues going on to buying upside calls that they just kept moving this thing until it looked like a curve like this. And I don't remember the exact steepness of it, negative. It probably was about -2. You tend to see negative slopes and skew in technology type securities. Why? Technology tends to have binary events because they come up with this new product and all of a sudden it changes, the whole dynamics of a company, right? Think about the company that discovers the cure for cancer. Let's say they develop a pill. What is that company going to do? It's going to do some crazy move to the upside. So you could potentially see skews inverting into the negative side of a slope. Okay. So that's what that all means. I typically would say most skews in listed options, the normal type stuff, Apple, Twitter, Facebook, they probably live around a slope of 1 to about 4 is what I've typically seen. Okay. This number being 1 to 4. And that's just how much of that put call variance occurs. Okay. Right in that range. And I always kind of start about 2 to see where it is and then move it up and down to see how I sit in implied. Okay. In that blue world. Last thing I'm going to say, and then if there's any questions, we'll take them. And otherwise we'll see you next week. Mark will be back next week. The other thing Skews is interesting for is you can get what we call a sawtooth, and I'm going to draw. So you can see the smoothness here and the relationship of the points. The points are pretty, systematic in terms of this curve. But every once in a while, what will happen is you'll see a point go like this. So it'll go smooth, and then all of a sudden, one point will be off of the curve, and then you go back to parity here, and you might have a little bit of this, and then all of a sudden, maybe you get a little down spike here. Okay, so you get a little what we call a sawtooth. Okay, so this is the sawtooth. Boom, then it goes here and boom, and it's not following a smooth, consistent pattern. Okay, so the sawtooth is important. Why? If you notice this, okay, where you'll get a point, and this point's not there, but pretend with me that this is the point. Okay, and it's a sawtooth. What happens is it says now butterflies get out of line a little bit because this is an expensive option. This is in line. This is in line. So you could technically buy this option, buy this option, and sell the expensive one, because over time, what should happen is that this little sawtooth guy right here, it's going to work its way back down to the line. Now, the other thing that could happen is your longs could work themselves back up to the line based on where the supply and demand goes. Okay, but sawtooths are really important, and you can do all kinds of spreads. If you see something expensive relative to the curve, like this again, we always want to make sure we're selling this option. We can certainly buy this into a put spread, right? Put credit spread, a bull put spread. If you don't like that and you wanted to buy this because you had a feeling that this stock was going down, you could buy this option, this put, and sell this one. Now we're into a bear put spread, right? Certainly could do that as well. Okay, so I've seen these skew curves used for that. And I'll check these every once in a while to make sure the curves are, here's what I look at first. I look at the implied and see that it's uniform. Okay, nice, beautiful curve. If I see any sawtooths, I'm going to go to my option chain and start seeing what's going on. I'll look at open interest. I'll look at volume. Maybe there's something going on. Some institution had an axe to grind and really wanted to purchase this, and it got a little bit out of whack. Okay, so that's the ways we use skew on the pro side. The other thing we can do, one last thing, sorry, is you can certainly look at comparatives of skew. So I just chosen January of 2022 to see what that looks like relative to the July, and then you could grab a third one and get a feeling for where volatility is. Now, what happens when you look at multiple ones together is what you want to see is where your at the money values tend to exist to one another. Doesn't mean that there's necessarily a play there, because you could have an earnings play in a farther out month. So you got to keep track of all that and understand that. So there could be news events farther out, which would cause volatility, implied volatility in a farther out month curve to be elevated versus the nearer term curves. Okay, so that's just another way that you can play skew values as such. All right, let's see. We have any questions here. Hold on a second. Why 25 deltas? Okay, I might have talked about a little bit about 25 deltas is kind of a, I hate to say industry standard, but that's the point at which your option goes from a reasonably priced option in terms of its premium value. And in this case, it's around 25 cents. And once you get beyond 25 deltas, you start getting crazy values. And I've only have 7 strikes here. If I showed all strikes, you'd get values that are off the chain. They're no bid at 3 cents, right? So no bid at 3 cents. It's not really a market. There's no trading there. It looks like 150 volatility. So we tend to look at out to that 25 delta, because that's where you get the most reasonable amount of true premium. Okay. Is tilt like Vega? Yeah, sort of. I guess you could consider that. Just keep in mind, tilt, when you measure tilt, okay, you're measuring this. Okay, you're measuring the flip-floppy of this. You're not measuring Vega, where if it goes up and goes down. So if volatility goes up and your slope stays consistent, you're going to get equal movement on longs and shorts with respect to tilt. Only way tilt is affected, and what it tells you numerically, is if I have negative tilt and it starts doing this, I'm going to be in trouble. If I have positive tilt and it starts doing that, I'm going to be in trouble. So it's more based on, tilt is based on the shape and severity of the curve, whereas Vega deals with implied volatility, movement up and down. Okay. How is tilt related to implied volatility? I think I just answered that. You can have this same shape can exist if volatility is 39 or 39.37. Okay. Or the same shape can exist if it's a higher vol. So what I'll do is I'm going to move this line up by about $1. So watch the shape. So I'm going to just see how I'm moving the points. So the representation of the points to one another is all in line with one another, even though I raised Vega. Okay, I raised volatility. So that shape, oops, that's a bad line to draw with, sorry. That shape still exists. Okay, it's uniform, right? It still looks like the original shape, right? It's just a higher volatility at the money volatility. And these points are consistent to one another with higher vols. Question is this dependent on data input by user? Implied is not. Okay, so what we like to look at, especially in TradeHawk, is implied is going to tell you a story that the marketplace is revealing. Okay, that's the blue line. That's really happening in the marketplace. Okay, so that has nothing to do with user input. It just has to do with what is in the marketplace, and we pick that up and show it on that blue curve. Now I can move these points to my red curve. The red curve is your curve. That's the one you create. And when you first go in to create these curves, what I typically like to do is I like to play with all these numbers to get it kind of into the shape, closest shape I can get it to that blue line, because that's what the marketplace is telling me it should be. And then I record those values. Okay, and I write them down on my notebook, and I kind of play with other months and see if I'm getting close and what have you. So the red curve absolutely is dependent on user input. Okay, you can model values and theoretical value using the red curve. Certainly can do that. You probably should really practice and have some good experience with that, because I always find that in the world today, with implied volatility, these markets are being made by real professionals. Okay, and what I mean by that is I'm not saying that we're not real professionals. Okay, but they have a different world that they deal with. They deal with billions and billions of dollars and high mathematics and high powerful computers that make these markets for them. Okay, they're not going to let them get out of line too much, except when they get overwhelmed with supply, and then you can see it. But don't forget, their computers, if this point gets a little high, ultimately this point's going to get raised, this point's going to get raised. It might not happen right away, and that's where your opportunity lies, right? And your other opportunity lies in the steepness of this thing relative to what you as a user define to be somewhat normal. Okay, and what TradeHawk will do is you can set greens and reds with a curve, and when it gets steep, you can see all the downside get really expensive, in which case those values will all be red on your screen, and the upside will get green. So you know that you had a curve change if that happens. Okay, yeah, this is a feature of this platform. That's correct. This is the Volatility Workshop. I'm going to show you where that is. I'm going to minimize this back down. So it's under Vol Workshop in this platform, right? Normal option chain. And then there's a Vol Workshop that you can mess with. Incidentally, make sure you go to the TradeHawk website, and I will copy paste it, because you can set up a tour with me to learn this platform. I don't know if anyone's done that or not, but I'll just put it in here. I'll copy paste it. So visit here. Okay, there's a place to set up a tour with us. It's a calendar app, and we do a Zoom and we talk and we run through this individually. So good place to do that. Yep, the tours is all educational. We record it, so 100% that's recorded. That's passed on to you. Make sure you subscribe to our YouTube channel, Options Brew TV. We do major episodes on Wednesdays with educators. They talk about their products. And we do a Thursday market shot educational series, and we also look at the markets and some of the things that are going on. But we have about a 10-part series coming up. This is the third in the series, and we're going to talk about all kinds of concepts with trading and how do the pros look at trading and valuing options. So next week's going to be a good show as well. Okay, great. Thanks for coming. And everyone have a great weekend, and we will see you next time on Market Shot Options Brew TV. Bye now.